Larry Summers, good to see you, man.
Good to see you, my friend.
So let me start off with this big inflation thing. I remember when you came out at the beginning of the Biden administration and you said, my God, inflation is going to be a very serious worry. And I mean, not only did the journalists pile on you, but like the White House piled on you. And now here we are and we have the highest levels of inflation in 30 years. So what did you see that they did not? Why did they all get it so wrong?
I don't really know. I applied what I thought was basic economic analysis. I looked at what the prospective GDP gap was. It was about 2%. I looked at what the fiscal stimulus was, about 15% of GDP. I compared them, assuming even a modest multiplier, and that told me there was going to be a substantial overheat. Then I added to that the recognition that monetary policy was incredibly loose. I added to that there was a real possibility that potential GDP, the economy's capacity, would be reduced by COVID. And I added to that there was a big overhang of savings from all the money that people couldn't spend during the first year of the pandemic. And it seemed obvious to me that we were going to have massive demand and we weren't going to have such large supply. And I don't usually make really strong off consensus economic forecasts because I think there's a lot of wisdom in the consensus, but this one seemed pretty clear to me. I think there were a number of, if I might, cognitive biases that got a lot of people to go wrong. One was what I call motivated belief. People really wanted to engage in a lot of support for families. And so they convinced themselves that what was politically imperative was economically prudent. That's one part of it. Another part of it was believing recent history and their then current model. And after 35 years without inflation, people basically kind of had assumed that inflation wasn't something that was coming back and it was something that was gone for good. And I think that was another part of the error as well. And I think it may have just been some difficulty in engaging in risks. And if you look at the magnitude of the initial stimulus, Ian,
Yep.
There was no one who did an economic analysis that said that it was the right size. That came out of after the Georgia election with the political imperative of the tax cuts and so forth. It was kind of a politically derived number, and it was the mathematics of the vote count rather than the mathematics of the economy that drove the choices that were made. And that has turned out to have led to something that I think was, in retrospect, a pretty clear economic error, one that was compounded by the actions of the Fed.
The 1.9 trillion you're talking about at the beginning of the Biden administration.
On top of the 900 billion. People forget that. There was 900 billion passed in December, and then there was another 1.9 trillion. So I didn't do anything really very hard. I looked and I said, relative to trend, how low were payrolls? And the answer was 20 to $30 billion a month. And then I looked at 2.8 trillion and I calculated that was about $240 billion a month. And so I said, if you put $240 billion a month in to close a $20 or $30 billion gap, even if there's a lot of leakage and there's a lot of delay and there's a lot of other stuff in the 240 billion, you're going to get yourself something that's got a good chance of being a problem.
Now, I mean, I understand that an extra $2 trillion is a lot of money. I also understand that at the time that it was passed, there was still an enormous amount of uncertainty in terms of where we were in the pandemic, the effectiveness, the rollout of the vaccines, the fact that you were still at that point looking at very high unemployment numbers. If you could have made that decision when Biden first came in, how would you have done it differently?
I would have done $1 trillion less. I would have, in fact, I did recommend at the time doing something like $1.5 trillion rather than $2.8 trillion. And then I think you would have had demand reasonably well matched to supply, and with demand reasonably well matched to supply, you would have had a much better kind of economic outcome.
Now, is inflation somewhat less of a problem in the United States now, in the sense that we have written a lot of checks? Absolute poverty levels are down, savings are up, Social Security benefits will be indexed to that inflationary jump. Is the scarring that's going to happen in the United States through this inflationary cycle going to be reduced as a consequence of all of that?
Maybe some, and there'll be people who will be happy when they get their Social Security index checks this January. That'll be up 5.1% from where they were before. On the other hand, they'll see that and they'll expect that we now have a kind of inflationary economy, and that will feed through to produce more inflation. Look, I think a lot of what's damaging about inflation is not its direct economic consequences if you do some kind of economic calculation. You're right that when prices start going up faster, wages start going up faster, and it sort of balances out for many people. Interest rates adjust, other things adjust. I think the problem is a society where inflation is accelerating is a society that feels out of control. And people feel like things were supposed to be brought under control, not taken out of control. And when they see prices at the gas pump, when they see what they're paying for meat at the supermarket going up very rapidly, they wonder whether things are under control, particularly if it looks like the authorities aren't seeing those things as a problem. When people get a 5% raise and there's 5% inflation, they think they deserved every penny of the 5% raise, and it's due to their good work, and that the 5% inflation is stealing their hard-earned gains. Now, the truth that we would teach in an economics class is that if there wasn't inflation, they'd be getting a 2% raise. But we all tend to internalize the good and externalize the bad. And that's what happens with respect to inflation. And so people see it as robbing them of the gains they would otherwise have gotten.
Biden's response to this, I mean, it doesn't feel like there's anything structural at this point that the president can do to respond to this challenge as we head into Christmas, Thanksgiving, difficulties with buying presents for your kids, can't get a turkey that's right size for my family. I mean, what are you going to tell Biden he should be doing right now, since he didn't listen to you last time around?
Look, I think the most important thing is that the Fed needs to acknowledge much more explicitly than it has that it had misjudged the situation, that overheating is the principal problem facing the American economy, that it will do what is necessary, starting as soon as is necessary, to assure the maintenance of stable prices, defined as an inflation rate that is running around 2%, that the president needs to be very clear as he refashions the Fed that he's going to be appointing people who are focused on the objective of making sure that we don't go back to the inflation of the 1960s and 1970s, that the Fed is a place for people committed to financial stability, not a place for people committed to being social justice warriors. I think he needs to signal that in the approach that he takes to the Federal Reserve System. I think they need to be careful that their Build Back Better, which I continue to strongly support, be fashioned in a way that isn't, even in the short run, substantially increasing the level of demand in the economy. And I think the president, in addition to focusing on clearing up the ports and doing that for supply chains, which is the right thing to do, absolutely the right thing to do, but is not a hugely important thing to do, needs to look at the full range of his policies. Should we buy America when buying America is much more expensive? Should we maintain every tariff when every one of those tariffs is holding up price levels and raising input costs for American producers? If OPEC should produce more oil, maybe we should too. And we need to keep that in mind as we look at fracking, as we look at natural gas. When we think about regulatory policies, don't we also need to pay attention to the costs of those policies, where they will feed into higher prices? Industrial policies are fine, but if the industrial policies are translating into higher prices, that's something we now need to be paying attention to.
A couple of questions there, but one immediately that comes up when you said, we have to ask about Buy American. I see that structurally in the sense that you're making a pro-free trade, pro-efficiency, get the cheapest things you can get, because that's going to help you with inflation. In the near term, in the immediate term, with supply chains being challenging, is it not a more right thing to do to try to simply buy more local?
No, I think the right thing to do is to buy cheap and buy inexpensive. And I think when we buy solar panels that are made in America that are more expensive than solar panels that are made in China, we're contributing to a higher price level and an inflationary psychology. When we procure components for infrastructure in ways that are designed to support suppliers in America, rather than to get that infrastructure as inexpensively as possible, we are contributing to a higher price level. I'm all for an agenda of resilience, but we need to think very hard about domestic costs and whether the policies we're pursuing are going to be constructive for the price level.
Now, you're an economist. Obvious political pushback on a lot of the things you're saying. One interesting one, you mentioned tariffs. And tariffs between the US and Europe are coming down. Tariffs between the United States and China, of course, are not. Are you suggesting right now a really smart thing to do would be for the Americans and Chinese to sit down and say, okay, let's reciprocally actually remove a bunch of those because we're just right now staring at the teeth of inflation?
For that reason, and because the tariffs are costing Americans jobs, look, it's a negotiation. It's a negotiation with the Chinese, and whatever our sins are, their sins are substantially greater. And when you're in a negotiation, you don't unilaterally make concessions without getting things. But I think the approach of maintaining truculence and resisting dialogue that was pursued at the beginning of the administration on the theory that the American economy would look substantially stronger and that America would be in a more confident position 10 months later. That was a strategy that some of us said was a mistake at the time. And it's a strategy that is now not looking very strong in terms of what's happened to economic sentiment in the United States because of inflation.
Last question, Larry. With all of these challenges that we're seeing, not just in the United States, inflation and supply chain challenges are global. Are you starting to worry a lot more about the potential for real economic implosion among the countries that don't have anywhere close to the governance and resilience and stability that the world's largest economy does?
Ian, I'm very concerned that a slowing of growth in the United States, and in particular, a big hike in US interest rates, which I think may well be necessary given inflation, is going to have all sorts of consequences for heavily indebted poor countries, and particularly poor countries that have a desperate need to borrow to meet the expenses of dealing with COVID, to meet the expenses of a world where there's a lot more protectionist pressure. So I think there's a prospect that this could lead to a very difficult period, and that period will not be, the difficulty will not be confined to the United States, and even will be more severe abroad.
Larry Summers, thanks so much for joining us on GZERO World.
Thank you. Bye-bye.